You may find yourself asking, why are there so many interest rates? I just want a 5-year fixed. Or your mortgage broker or your banker saying, you can't get that rate. You ever wonder why? It all has to do with mortgage insurance and mortgage-backed securities. Stay tuned. As far as lenders are concerned, a mortgage is an asset. That is, they advance a bunch of money and expect a stream of payments with interest in return. Now, once a bank creates a mortgage, instead of just sitting on it, what they do is they turn around and sell that stream of payments on what's called the MBS market. Now, they don't sell mortgages one at a time. What they do is they create baskets of similar mortgages, that is, characteristics such as the property type, the loan to value, the income of the borrower, the credit worthiness of the borrower and such, and sell groups of mortgages together in order to get more money to do more mortgages. These baskets are known as mortgage-backed securities, or MBS for short. Mortgage-backed securities behave similar to bonds in that in return for a lump sum they provide a stream of payments. Now, the payments are affected by the interest rate, and the interest rate is set according to the inherent riskiness of those payments. The inherent riskiness takes into account the creditworthiness of the borrower and their ability to repay, as well as the value of the mortgage relative to the homes that they are secured against. The more risky the underlying security, the higher the interest rate. The movie The Big Short was about this very topic in America. However, in the case of The Big Short, what happened was that lenders misrepresented the riskiness of the underlying security. This meant that the pricing was too thin. Normally, the riskier an investment, the higher the expected return. In the case of a mortgage, the more risky a mortgage, that is, the less likely the borrower is to pay, the higher the risk premium, i.e. the interest rate. Bottom line is that the riskier the mortgage, the higher the interest rate you can expect to pay. The mortgage market in Canada is governed by OSFI, the Office of Superintendents of Financial Institutions, a federal government body. They classify mortgage into two broad categories, high ratio and conventional. High ratio mortgages are for those with less than 20% down payment, and they always require insurance. Conventional mortgages are divided into two categories, insurable and uninsurable. Mortgage insurance in Canada is provided by three providers, CMHC, a Crown Corporation, and Genworth and Canada Guarantee, private companies. While their structures are considerably different, they actually behave very similar, and the premiums they charge for insurance are pretty much the same on almost every product. Broadly speaking, insured and insurable mortgages are only available for purchase transactions and transfers with a property value under $1 million and amortization of less than 25 years. The insurable option is a little bit confusing to consumers, as they are actually insured on the back end once they hit the MBS basket, but the insurance is paid for by the lender. The premium for insured mortgages, again those with less than 20% down payment, is paid for by the consumer directly, and while you can pay it at the time of the transaction, it is normally added to the mortgage balance. A $500,000 purchase price with a minimum $25,000 down payment, that's 5%, will cost you $19,000 in insurance. So your mortgage is actually $494,000 on a $500,000 property. You've really only got $6,000 in equity because most of your down payment went to pay for mortgage insurance. It's important to understand that both kinds of insurance are actually mortgage default insurance. They don't really benefit the consumer directly other than to provide them with a better interest rate. What happens is if you default on a mortgage and the lender tries to collect, takes you to court, sells your house, and still doesn't have enough money, then they get to collect insurance. So how does insurance affect mortgage rates? Well, generally speaking, the more down payment you have, the less risky your mortgage is. You have more equity in the property, and therefore in the event of default, the lender has more security that they can realize on. In the case of high ratio mortgage insurance, the premium changes based on your amount of down payment. from 2.4% when you're just under 20% down payment, right up to 4% if you only have 5% down payment. Because in the case of insurable mortgages, the lender is paying the insurance premium, they instead pass on the risk to the consumer in the form of different interest rates. Now, these different interest rates generally change in a gradient of 5 to 10%. And to cite a recent example, 20% down payment got an interest rate of 5.24 on a 5-year fixed. 35% down payment got an interest rate of 4.89. Generally, once you get past 35% interest rate, you don't get any additional benefit. Interestingly, the interest rate on the 35% down insurable mortgage is often exactly the same as for the high ratio mortgage. But remember, in the case of the high ratio mortgage, the consumer is also paying the insurance premium, so is effectively paying a much higher interest rate. Advertised rates are almost always high ratio insured. That is, you won't be able to get them unless you're buying a property for less than $1 million, are able to qualify on a 25-year amortization, and are willing to pay a 2.5% to 4% premium or have 35% down payment. It just goes to show it pays to shop around. Do your legwork or engage with a good mortgage broker. Have a great day.